So welcome, everyone. You came to Columbia Business School and you took or are taking our signature corporate finance core. And what do you study? You study discounted cash flow, WACC, beta, unlevering, relevering, residual value, etc. Okay? So my research will show you that they're extremely useful. Okay? So for conducting this study, I read through a lot of the core docs where different stakeholders dispute on evaluation. Okay? And you will see what the plaintiff think, what the defendant think, what the expert witness think, what the judges eventually decide. And the methodology that we rely on is exactly this. Okay? So today I'm going to talk about what do you do or what will happen if two parties disagree on the evaluation company. And it happens quite often in M&A, LBO, going private, etc. Okay, so if you will eventually work in an M&A team, whether on the acquirer side, target side, or financial advisory side, you have to be aware that about 1 in 4 cases, someone will dispute your valuation. Okay? So now, some of the shareholders, they will feel grieved because they didn't want the company to be bought, but they belong to the minority. So eventually the company did get bought. So can they air their grief somewhere? Okay? Or if you're a professional money manager, do you smell some opportunity that you can conduct some arbitrage? Okay? Now let me give you a motivating example. I think this is probably the most high-profile case in appraisal. So in late 2013, Michael Dell, the CEO of Dell Computer, decided to take the publicly traded computer, which is called Dell, private, meaning the company will be delisted and become a company that's privately held by Dell, as well as a private equity firm called Silver Lake. Now, before a company goes private, do you think the company tend to demonstrate exceptionally good performance or some unusually bad performance? Unusually bad, okay? Because if you are the insider and if you want to take the firm private, you don't want the price to be very high. And it's not difficult to do so. If you ask me to be a CEO, my job is to increase the value of the company. It's a challenge, but if you ask me to do the job to destroy value, I probably will be able to do so, okay? So after a series of disappointment, when the shareholders are unhappy, so Michael Dell will come out, say, hey, if you're unhappy with us, let me buy you out, okay? And the proposal will be a per share price of $13.75, representing a 28% premium. Now, it has to be for vote. So the target shareholders, this is the Dell shareholders who voted, 70% of the shareholders voted yes. Why? Because if you hang on, there's no guarantee you get a high valuation. If you're a mutual fund manager, you're very happy to record this 20% premium on your book and just move on. Okay? Now, some shareholders really feel that they were ripped off, will be T. Rowe, which is a major mutual fund family, and they are here to fight for justice. Okay? Because they were here, they were unhappy with the valuation, so they want a high valuation. Now, some new investors, including Kai Icahn, and Dan Loeb, who is a Columbia College alum, and also Mellon Capital, they actually became shareholders in order to make a profit. Because they became shareholders because they thought the valuation might go higher. So these are the investors who are here for profits. Okay, now what do? Is that you refrain from voting, and instead you surrender your shares to the court, in this case, the court in Delaware. Okay? So you basically give your shares to the judge, say, Mr. Judge, could you give us a fair valuation? Okay? Now, then the defendant as a plaintiff will all hire their own expert to conduct a valuation. The main method is called DCF. Okay? Unlevering, relevering, those concepts will appear. And eventually, now, how long? So that was October 2013. Now we're in May 2016. Okay? So Judge Laster eventually decided that the Dell valuation was 17.62 share per share. Okay, so you are making a profit of 1/3 in 2.5 years. Not bad, isn't it? Okay, so for this party, they had the justice. For these parties, they made a profit. Okay, So this is a link for the New York Times reporting the event, and my research was quoted in the news release, which I felt very happy about it. Now, how common is it? Okay, so if you look at 2000 or before, it happens 5 times a year, so you are free to ignore. Okay? Now today, last year in 2016, there were almost 50 cases. Okay? And in recent years, the appraisals will happen in about 1/5 to 1/4 of the eligible cases. Now, what are the eligible deals? The eligible deals is basically cash deals. Okay, so you can only seek appraisal if the currency paid to you is in cash. It doesn't apply to stock deals. You ask me why? I don't know. I don't think there's a profound economic reason. There could be a law reform, but right now, eligible deals are really just cash deals. Okay? So this is why I say eventually if you work on an M&A deal, if it's a cash deal, you have to bear in mind that's a 1/4 of chance someone might challenge your valuation. Okay, now who are they? So this chart shows the composition of people who would dissent on the valuation and resort to a court. Okay? Now in the past, this gray bar was a majority, and who are they? Individuals. Okay? Individuals for profit or for justice, they're here to make a small buck. But more recently, who have become the major players? The hedge funds. Okay? So you can kind of tell this is a system originally probably for justice for grieved investors, but more recent years, it has become really an arbitrage opportunity. Okay? Because hedge funds become shareholders in order to get the appraisal. Okay, now, what kind of deals are most likely to be targeted? Very intuitive. Low deal premium. Okay, now the average deal premium is 36%, and that number has been pretty stable for the past 4 decades. So if you want to take over a company, you tend to pay a premium between 30 to 40% of the most pre-rumor traded price. Now, the deal's actually been challenged with a 21% premium. So when you go to the judge, you say, the average deal pays 35% and our deal 21%, you can see how unfair it is. That's kind of the starting point. Okay? Now, the going private deals are primary targets. So previously I mentioned about 1/4 of the deals are targeted, right? But if it's a going private deal, the probability is closer to 30%. Okay? Now, you know, the going private deals are particularly vulnerable to conflict of interest, because people who want to buy the firms are also the people who are currently controlling the firms. Okay? Now, the third one is called minority squeeze out. Okay, so if you're unfamiliar with this term, meaning an acquirer first acquires, say, 51% of the firm. Okay, so the 49% of the shareholders did not go along. It's a tender offer. Once you have 51%, you take control of the company. And one day you can decide to squeeze out the 49% because they're minority. Okay? So when minority shareholders are frozen out, okay, they might be left in the cold. Okay? So appraisal would be their last resort for their justice. Okay? Now the last one is high institutional ownership. This is kind of interesting. In recent years, the appraisal dissenters are more likely to target companies with high institutional ownership because they believe they have a more sophisticated shareholder base to communicate with. Okay? Okay, so this is how big the stake is. It has a long tail, like everything else in today's world. Okay? So this is the 5th percentile, and this is the 90th percentile. So how to read this chart? It shows that there's 5% of the deals, they will have ownership over 25%. And they will have a dollar stake about $170 million. Those are huge. I'll call the sharks. Okay? The median, 2 million, 1.4%. Now there's a huge left tail that's close to nothing. Now how many shares you need to own in order to be eligible to dissent? Very little. 100 shares or $2,000. Literally, there's no lower limit. That's why you see the lower tail. Okay? Now, this is a shark with a lot of remuras. So remuras are those small suckfish. Okay? So they stay with the shark for a happy free ride. Okay? And they live on the parasite as well the leftover food of the shark. Okay? So here are the big guys who are putting a major stake, and a lot of small people, they just tag along to save on their litigation cost or just some common campaign cost. Okay, so this is a huge tail on both ends. But the median, something to remember, it's 1.4% and 2 million. Not a quick buck. Okay, if for you to be in this business, you have to be very patient. Okay, now these are the settled cases, meaning you settle out of court to save the litigation, a lot of litigation costs. The median is 228 days. If you strike all the way to the court, 2.5 years. Okay, so the Dell deal is this. Now, sometimes people would wonder, wow, I need to tie up my capital for 2 and 3 years. Is it worth my money? Is it worth my time? The answer is a big yes. Why? Because when your capital is tied up in this litigation, okay, the target firm is obligated to pay you by law 5% plus federal discount rate. Wow. Okay, so when the 10-year Treasury bond is traded at, you know how much today? 2.43, right? So when the 10-year bond is traded in 2.43, would you like the case to last as long as possibly can and collect your 5% plus LIBOR? Okay? So this is why I start to wonder what this appraisal is, a valuation arbitrage or a backdoor fixed income arbitrage. It could be both. I'll show you the number. It could be both. Okay? So nobody, in this case, nobody is complaining about the low efficiency of a court system. Okay? In fact, you want to be as inefficient as possible. What about 10 years? Be happy to lock in 5% plus LIBOR for 10 years at this rate. Okay? So it's not a quick buck, but nobody's complaining. That's the important part. Okay? So here's the return. This is the average return. This is the median return. This is raw return, annualized raw return, market-adjusted return, market-adjusted annual return. How do those numbers look to you? Good? Modest? I say very good by today's standard. Okay? So no wonder the strategy attracts so many hedge funds. They squeeze out individual bases and taking over the whole domain. And I'll tell you one more merit of conducting such arbitrage. The raw return never falls below 0. Okay, do you know why? Why the raw return never falls below 0? It's not you can, it doesn't happen. The reason is the same as you experience. Now, some of you, after final exam, go back to the professor, ask for a regrade. That's professor's nightmare. Okay, but we deal with it. Now, have you ever heard after professor regraded your exam and give you a lower score? Did it happen? It's possible, but never happened. Right? Now, what is appraisal? Appraisal is that you ask the judge to regrade the valuation. Okay? If the judge doesn't like you, it will say, I uphold the original valuation. It will not say, no, you're such a troublemaker, I decide to lower your valuation. That, in principle, it happened, except it never happened. Okay? So this is why the worst case is that you get a 0. Okay? Now, how many investment strategies you can think about that will have these kind of numbers plus a lower bound of raw return of 0? Okay? But that's why it is so unusual. Okay? Now, if I decompose return, it becomes even clearer. Okay? So this is the total raw return. That's only for trial sample, because if they settle out of the court, I really don't get to see the detail. Okay? Sometimes see the total valuation, but I don't know how they decompose into interest accrual versus the damage versus the valuation improvement. But for the trial example, which is about 40% of cases, I have detailed information. So if you last all the way to the trial, your returns even more phenomenal. So in 2 to 3 years, you earn 100%. And the interesting thing is that the value improvement is 50.6%, and interest accrual is 56%. Yes?
Is this already accounted for the whole improvement?
No, I haven't, but I will talk about it, okay? So this is a median. Now what do you conclude is that the interest accrual is just as important, if not more, than the value improvement. Okay? So that's why you can almost view appraisal should be conducted by those fixed income funds, right? It's really a fixed income arbitrage, except they're not conducted by fixed income funds. Now, let me get back to this gentleman's question first. So legal cost. The legal cost we estimated. So in this space, the lawyers tend to charge 20% of the total recovery. About, okay? Up to a certain level, which is 95% of the deal. So above certain threshold, 10%. So you're still retaining the majority of the return. And the dollar term, if I calibrate at a median, it's about 2 million, okay? But for some of the small players, if you just hold, say, $100,000, you could have a 500 legal bill because you just fill a very pro forma form, hand it in, and have a strike suit. Could be as little as a couple of tens of $1,000s, as much as 10 million. The median is about 2 million. Now, Dell Case, it was very expensive. I think that's this gentleman's turn. Did you, who asked for that?
I was just
Yeah.
curious, is that this Delaware case law?
So it's not just the Delaware case law. However, most, a great majority, like 85% of the appraisal cases occur in the Delaware court because this court is the most experienced. People can predict what will happen, so people don't like uncertainty. Yes, that gentleman.
If you do not get anything that like zero extra valuation, does the court sometimes make the plaintiff pay for the legal costs of the counterparty?
Yes, so basically, when I say the zero raw return is pre-legal cost. So with legal costs, you can still have a net loss.
There should be some kind of incentive so that not everybody would go ahead and challenge valuation.
That's true. That's true. That's true. So this is why we only observe 1/4 of the cases are challenged, and those are the cases apparent with low paid premium. So it's very difficult for you to challenge a 60% premium case, right? Because the value improvement is limited, you might incur a huge legal cost. Okay? So this is the return decomposition. Okay? Now, finally, the lawyers kind of think, gee, it doesn't make any sense, the 5% plus LIBOR, because it was set when the Treasury was paying double digits, right? So at that time, it was meant to be a penalty. Like if you tie your capital with us, you only get 5% plus LIBOR. If you invest in Treasury, you could get 12%. It was meant to be a penalty, but it didn't change, and today it's completely out of line with the general financial market conditions. So since June 2016, there was 2 reforms. One is called the de minimis exception, meaning no longer 100 shares, $2,000. Now you need to have at least 1 million or 1% in order to launch a charge. Okay? That might eliminate 25%. However, when I show you the chart, is there any indication that the 2016 deals are dying away? No. People coming in greater force. Okay? Now the second one is called interest reduction amendment, meaning the target firm can prepay you the existing valuation. So you're not earning interest on the total amount. You will only be earning interest accrual on the value improvement part. Okay? So that is the second reform. However, people seem to figure out a way to get around it. So despite these reforms, seems appraisals are still here to stay, because one is people figure out how to do it in a professional, efficient way that they could earn a return even without the help of the 5% interest rate. And second is like all other economic activities, this appraisal before was conducted by random grieved investors, now are conducted by professional people. And they're just so much more effective in doing anything they choose to do. Okay? So this is pretty much what I want to talk about. Thank you very much. Mm-hmm.